Welcome to Mjinsight. Today, we are going to delve into the issue of China's real estate. As we all know, recent serious events such as defaults and bankruptcies of Chinese real estate companies have occurred in the global capital market, which may even trigger systemic risks and make everyone talk about it. China's real estate seems to be standing on a huge macro control policy chessboard. The government's policy of destocking and leveraging is like a double-edged sword. On the one hand, it suppresses the ballooning housing prices. On the other hand, it makes the market full of variables. How big is the risk of China's real estate market? This is the question we want to explore. To answer this question is difficult because there are many factors that affect real estate risk, and we cannot explain all the problems in a short video of a few minutes. However, based on reading a large number of documents, we have selected 3 key indicators commonly used to evaluate real estate risk, including the house price to income ratio, rental yield, and vacancy rate. By comparing the gap between international cities in these indicators, we can roughly understand the performance of China's real estate market in these aspects. First, let's take a look at the house price to income ratio. This indicator is like a thermometer for real estate and can reflect the weight of living burden. In China's first and second tier cities, this ratio is astonishingly high, averaging around 20, while in third and fourth tier cities, it is relatively reasonable, at around 10. Specifically, the ratio in Hong Kong, Shenzhen, and Beijing exceeds 40, far exceeding the average level of international first-tier cities. For example, the ratio in New York is only 10, and in London, it is 15. This means that a person can only afford a house after not eating or drinking for 40 years. If daily expenses such as clothing, food, and transportation are excluded, this time will definitely be longer, maybe 50 or 60 years. These numbers are like a huge mountain, daunting. Do you think this ratio is reasonable? Would you live in such a city? Please share your thoughts in the comments. Second, let's look at rental yield. Currently, the static rental yield of major cities in China is 2.6%, and in first-tier cities, it is even lower, at around 2%. In contrast, the international static rental yield is usually between 4% and 6%. In China, the problem of low rental returns is particularly prominent in first-tier cities. For example, the rental yield in Shanghai is slightly higher than 1.5%, while in Guangzhou, Beijing, and Shenzhen it is lower than this level. This number reflects a contradiction in China's real estate market. Although housing prices are high, rental returns are surprisingly low. Such low rental returns reveal the extremely unbalanced demand for housing and rental occupancy in China, which is an important sign of the bubble in China's real estate market. China's real estate market not only serves residential purposes, but also bundles various resources such as education, healthcare, and public services. This composite demand for housing significantly drives up property asset prices far beyond their fundamental residential value. Third, let's focus on the vacancy rate. The vacancy rate reflects the problem of supply and demand imbalance in the real estate market. According to data from the China Household Finance Survey (CHFS), the housing vacancy rate and the number of vacant houses in China have been increasing year by year, and the housing vacancy rate in some Chinese cities has reached an astonishing level. For example, in 2017, the vacancy rate reached 21.4%, and the number of vacant houses reached 65 million sets. In second and third tier cities, the vacancy rate is even higher. What is the vacancy rate where you are? Please share your observations in the comments. The current vacancy rate of Chinese residential properties is far higher than the natural vacancy rate, showing a high degree of bubble. From the perspective of residential properties, the higher vacancy rate in small and medium-sized cities may be due to excessive construction, and the vacancy rate in large cities may be related to excessive investment in real estate speculation. From the data in these three aspects of the house price-to-income ratio, rental yield, and vacancy rate, we believe that everyone can make their own judgments on the risk level of China's real estate market. Although these data cannot directly reflect the investment risk of buying a house and the investment risk of real estate-related stocks and bonds, they can provide some support from a fundamental perspective. We hope that these data will be helpful to your judgment. Thank you for watching. If you have more thoughts on this topic, please leave a message in the comments and share your views. Don't forget to like and subscribe to our channel so that you don't miss out on future exciting content. See you in the next video.